mitigate risks, manage liquidity, access capital, and raise credit. During the COVID-19 pandemic and associated economic disruptions, CCMC has informed policymakers about a myriad of important issues ranging from financial regulation, fiscal policy like the SBA's PPP program, and monetary policies implemented by the Federal Reserve. One of the most important policy responses to the crisis has been the emergency lending programs authorized under Section 13.3 of the Federal Reserve Act. The Chamber has been broadly supportive of the Fed's emergency lending programs. We supported the congressional appropriations to backstop the programs and gave feedback to the Fed and Treasury to help them design facilities that support American businesses, their customers, and their employees. We are thrilled to hope Daleep Singh here today, who is Executive Vice President and Head of the Markets Group at the New York Fed. The Federal Reserve Bank of New York operates the primary market corporate credit facility and secondary market corporate credit facility. Mr. Singh oversees the market group's full portfolio, including implementing monetary policy, monitoring and analyzing global financial market developments, executing lender of last resort operations, and various other responsibilities. Prior to joining the New York Fed, Mr. Singh was senior partner and chief U.S. economist at the global investment firm of SPX Capital. Before that, he served at the U.S. Department of Treasury from 2011 to 2017, serving as acting assistant secretary for financial markets and deputy assistant secretary for international affairs. Mr. Singh holds a bachelor's degree from Duke University in economics and public policy. He also holds a master's of public business administration, master's of public administration from MIT and Harvard University with a focus on international economics. Mr. Singh will provide prepared remarks detailing the importance of both the PMCC facility and the SMCC facility as well. But one little housekeeping item. Before we get started, we ask that everyone please mute your microphone and turn off your camera during the event in order to save bandwidth, etc. So with that, Daleep, let me turn it over to you. Thank you.
Yeah, thanks very much, Tom. Thanks for the invitation to join this event, and thanks everybody for joining. So as all of you know, in March, the Federal Reserve, with backing from the US Treasury, created a set of facilities to purchase corporate credit for the first time in its history. Many observers have credited the facilities with repairing market functioning in the corporate bond market and restoring the ability of many businesses to finance themselves through the pandemic. But my focus today is not the corporate bond market, credit spreads, or Wall Street. Rather, I'd like to connect the dots by explaining why these facilities were necessary to support jobs and the economic recovery on Main Street, and why transparency, access, and accountability were so critical to their implementation. Before I review the initial success of these programs, I want to acknowledge the painful realities that many firms, employees, and households continue to face. For millions of Americans, it's a long road back to normal. I should also make it clear that these remarks are my personal views and not necessarily those of the New York Fed or the Federal Reserve System. Okay, so let's start with some context and recall why unprecedented action was necessary in March. Amid a synchronized global demand shock of uncertain length and severity, access to credit takes on outsized importance. Companies that issue public bonds and commercial paper depend on financing to make investments and meet their obligations, including payrolls, and together likely account for nearly 1/4 of all US private sector employment and just under 50% of US output. Even companies that do not themselves have public bonds are closely linked to the supply chain as they receive trade credit from or sell to large corporate bond issuers. Research suggests that shocks impacting large businesses spill over to smaller firms, perhaps accounting for 10% of the reduction in employment at small firms during the last recession. The unusually high level of uncertainty about the pandemic shock was reflected in the functioning of markets that finance large US employers. Market liquidity, the conditions under which companies' debt is issued and traded, rapidly deteriorated to levels experienced during the global financial crisis. Even for investment-grade companies, the cost of debt skyrocketed to 5 times pre-pandemic levels. At the height of the strain, many companies lost access even to short-term financing, and issuance of longer-term corporate bonds declined precipitously. From late February through early March, overall corporate issuance dropped 60% year over year, with virtually no issues pricing on several consecutive days. Firms that could not access capital markets were at risk of being weakened irreparably. As revenues fell and without access to capital markets, companies initially relied on cash buffers and drew down relatively expensive bank-funded credit lines. Markets quickly priced in dire outcomes from the unfolding credit crunch. As one illustration, nearly 500 billion of high-yield bonds, or about 40% of outstanding issues, were trading at distressed levels in mid-March. Considering that corporate bonds typically include cross-default provisions, where a default on one bond issue triggers defaults on all of a company's outstanding debt, the total amount of public bond claims that could have entered bankruptcy were several multiples of this amount. With widespread financial disruptions threatening to spill over into the real economy and putting millions of jobs at risk, a bold and aggressive policy response was required. So on March 23rd, the Federal Reserve, with support from the US Department of Treasury, announced a broad set of emergency lending facilities, including the primary market corporate credit facility, PMCCF, and the secondary market corporate credit facility, SMCCF. Together, I'll call these the CCFs. Now, the ultimate goal of these facilities was to provide a bridge for US companies and their employees to the other side of the pandemic shock. To achieve this goal, it was critical to provide broad support for both the primary market, where companies access credit, and the secondary market, where the debt of large US companies trades. These two markets are linked. The pricing of corporate debt traded in the secondary market informs the cost of financing for newly issued debt. Now, these two facilities differ in terms of mechanics. With the PMCCF, companies must approach the Federal Reserve to finance or participate in the issuance of new bonds. The PMCCF is designed to be a backstop and is priced at a premium to market rates. By contrast, purchases through the SMCCF are not initiated by a company. Instead, we purchase small and proportional amounts of outstanding debt of eligible companies at fair market value in the secondary market to provide broad support to the credit market. In executing secondary market purchases, we take our cues from market functioning. Our staff conducts rigorous monitoring of credit market conditions, as well as broad outreach to understand the nuances of market dynamics. The pace of SMCCF purchases is dependent on measures of market functioning and market volumes. For a given level of market stress, we set our purchase pace as a share of market volume. The percentage of market volume that we purchase each day is based on a broad set of market functioning indicators that measure the issuance and trading of debt. When there are market disruptions, as in March, the deterioration in liquidity emerges in a number of ways, including higher transaction costs and higher volatility. Purchases increase during periods of high trading volume, which often coincide with an uptick of market stress, and they're dialed back when trading volume is low to ensure we do not crowd out private investors. The purchase framework also adjusts the instruments employed according to market functioning. We initially executed in the secondary market by purchasing US-listed ETFs. As direct bond purchases came online and market functioning improved, we scaled back our ETF purchases and stopped buying ETFs altogether in late July. If market stress were to return and our purchase pace were to increase, we would initially focus our support primarily through direct purchases of corporate bonds. And in a scenario of significant market stress, we could buy both bonds and ETFs. By varying both the amount and type of purchases, we're able to provide flexible support to the market. Let me now highlight several design features of these facilities that proved critical to their. The facilities were large enough to demonstrate the Federal Reserve's resolve in putting a floor on the pandemic's impact on credit markets. Indeed, the PMCCF and SMCCF have a combined capacity of up to $750 billion, equal to 8 months of investment-grade corporate bond issuance at the pre-pandemic pace. Second, close coordination with the U.S. Treasury acted as a force multiplier. The equity committed by the U.S. Treasury facilitated broad support for large employers. The facility's combined capacity leveraged Treasury's committed equity contribution of $75 billion by up to 10 times. Third, the support provided by the facilities is broad. Excluding banks, all U.S. domiciled firms with an investment-grade rating prior to the facility's announcement were eligible, thus concentrating support for firms that primarily face liquidity strains due to the pandemic. The facilities also provide support for firms with ratings just below investment grade to mitigate the cliff effects at the boundary of our support. Together, these programs backstop about 80% of corporate bonds outstanding, excluding those issued by banks. Finally, policymakers signaled their willingness to adapt. Even before purchases began, the size of the equity injection and purchasing power of the facility was increased, and the scope was broadened to allow support for fallen angels, or bonds downgraded below investment grade, but no lower than BB- after the CCF announcement. In addition to program design, the principles that guided the implementation of these facilities, access, transparency, and accountability, reinforced the credibility of these facilities and their impact. Providing broad access to the facilities for corporate borrowers was essential, both to expand the reach of backstop support for the economy and to ensure that the allocation of credit. Our initial purchases were in a diversified set of ETFs that provide broad exposure to the market for U.S. corporate bonds. Purchasing via ETFs offered efficient and rapid transmission of broad-based support to the secondary market. At the outset of these purchases, we communicated that ETFs would only be used if their purchase is reasonably expected to achieve the objectives of the SMCCF more effectively than the purchase of underlying bonds. 1 month after starting ETF purchases, the Federal Reserve announced a framework to use corporate bonds as the SMCCF's primary vehicle for providing support. In preparation, we had created a broad market index of eligible corporate bonds, weighted proportionately by the amount of debt outstanding from individual companies. We then began purchasing bonds across the index in a rules-based manner, taking care that our purchases are neutral towards eligible sectors and companies. I should note that in making an assessment of credit eligibility, we broadened our use of ratings to include perspectives from all nationally recognized statistical rating organizations. Providing broad access also applies to the service providers that support the facilities. In early September, we announced the expansion of counterparties to the SMCCF, including several smaller and minority-owned broker-dealers. In early October, we announced the launch of our process to rebid our engagement with the facility's investment manager. This process has begun with the CCF cash management role, and in the coming weeks and months, we will rebid the remainder of the role. Together, these efforts allow us to expand the reach of our operations while making tangible progress on our commitments to diversity and inclusion, including to minority, women, and veteran-owned firms. Let me now turn to transparency and accountability. In the spirit of these principles, we have reported to the public in near real time our market activity, including the details of every SMCCF transaction. Our holdings are publicly reported on a weekly basis through the Fed's H-401 release. Every month, the Fed publishes the full holdings in a detailed congressional report. We also provide the attributes of the broad market index, including detailed issuer level weights. Aside from portfolio activity, we've also disclosed the CCF's legal agreements. On the New York Fed's website, you can find all documentation with the Department of Treasury that governs the operation of the facilities, as well as all contracts with external vendors. On the latter, we remain committed to disclosing all fees paid to service providers as they take place. Now, as you all know, corporate credit conditions have recovered substantially from the worst strains of March. Research from the New York Fed estimates that within the first 3 months following the CCF announcement, credit spreads were traced about 90% towards pre-pandemic levels, with 2/3 of the improvement occurring on facility announcement dates, i.e. before purchases even began. And half of the improvement in bid-ask spreads since the peak in March occurred on the initial announcement date itself. This provides strong evidence that the market found credible the design of the CCFs, as well as the Federal Reserve's commitment to following through. Improvements in secondary market conditions pass through to corporate borrowing costs in two ways: directly through borrowing rates that are benchmarked to secondary market yields of similar bonds, and indirectly by increasing the willingness of dealers to underwrite bond issuance. And this is precisely what we've observed. Since the CCF announcement, firms have raised about $1.5 trillion in the corporate bond market from investors, or about double last year's pace. Companies have raised new funds and refinanced maturing debt, helping them to maintain their operations and payrolls and build liquidity buffers against continued uncertainty. Importantly, the dramatic improvements in credit conditions have come despite an extremely small CCF footprint that has decreased over time. On account of healthy primary markets, the PMCCF has yet to be tapped. And since mid-May, when we began SMCCF purchases, the pace of our buying has fallen steadily in response to improvements in market functioning. In May and June, we purchased about 300 million per day, or about 1% of average daily trading volume in the secondary market. And that pace declined to about 20 million per day by September, or less than 0.1%. Currently, the SMCCF holds about $13 billion of overall exposure across corporate bonds and corporate bond ETFs. This is less than 0.2% of the outstanding bonds in this $8.7 trillion market. As we've said previously, if further improvement in market functioning occurs, we could slow SMCCF purchases further and potentially pause daily purchases entirely. Conversely, if market functioning measures indicate deterioration, the SMCCF remains available to ramp up support. Now, despite the small footprint of the CCFs, we know the signaling effects have been potent. Indeed, this is the main channel through which these facilities have had an impact. And we remain watchful for the risk of creating distortions. One possibility could be that companies issue shorter maturities than they would otherwise to benefit from the presence of the CCF backstop. So far, we see no evidence of this behavior. If anything, there's been a tendency towards refinancing maturing debt at longer tenors. Another distortion could be excessive amounts of corporate debt issuance based on future expectations of an official sector backstop. This moral hazard risk will bear watching over the coming years, but there are at least a couple of reasons to believe it's muted in the current circumstance. For one thing, global pandemics are an extremely infrequent occurrence. For another, backstop support from the CCFs has been restricted to investment-grade issuers and fallen angels, thus limiting the incentive to over-leverage. To conclude, I'd like to turn from the execution details of these programs to the bigger picture of outcomes in the economy. As I noted at the outset of my remarks, the linkages between capital markets and employment are critical to understanding the purpose of the CCFs. Large companies rely on capital markets to secure ongoing financing to maintain their business operations and meet payrolls. By supporting companies' access to funding, firms employing millions of Americans are in a better position to keep workers on payrolls and to hire them back as the economy continues to recover. Let me make 3 observations in this regard. First, companies that issue public bonds tend to be large employers. US companies with bonds that were due to mature this year and next employ more than 21 million people. Those that have accessed corporate bond markets since March employ more than 16 million people. Without seeking to minimize the stress on those households that have experienced unemployment, I want to highlight that the vast majority of jobs at large corporations have been maintained. Second, companies that issue public bonds tend to generate large investments. US companies with near-term bond maturities spent more than $1.1 trillion on capital expenditures last year, just over 1/3 of the total. This translates into spending that touches multitudes of other firms and their employees throughout the economy, including private and smaller firms. Third, the removal of tail outcomes in credit markets matters for employment decisions. Researchers have documented this relationship through an association between credit market sentiment and employment forecasts. Holding all else equal, if excess credit risk premia remained at their March highs, the median payroll forecast as of the third quarter of 2020 would be lower by approximately 1.8 million jobs. Meanwhile, at the fifth percentile, a proxy for the adverse tail scenario, payroll jobs. Interpret these findings as a rough sketch of the counterfactual. Had we not provided a robust funding backstop, how many more companies would have shuttered operations and laid off workers, either out of necessity or out of caution? If companies had been unable to refinance maturing bonds, how would their defaults have cascaded through supply chains and employment outcomes? We'll never know these counterfactual scenarios with precision. Suffice it to say, though, that considering the downside risks to the economy that we faced in March, the CCF's 13 billion of purchases and committed backstops provided enormous benefits to the country. Access to credit, economic output, and employment outcomes are intimately connected, and it was imperative that the Fed step in to prevent a negative spiral and provide a bridge to the recovery. As Chair Powell has noted, the Federal Reserve remains committed to using its full range of tools to support the economy for as long as is needed to ensure that the recovery will be as strong as possible. Thank you.
Daleep, thank you very much for those very interesting remarks, which I think painted a very effective portrait of the CCFs. If we can maybe start from where you sort of were maybe at the end of your remarks, so we can maybe take a look from maybe a little more of a global view and then drill our way down a little bit. As you noted, businesses use corporate bonds for a lot of different purposes, right? It could be to meet some short-term cash obligations such as payroll, or it could be for growth and to build up inventory, which obviously that was not necessarily the case when we were in March. But the primary market and the secondary market corporate credit facilities were important bazookas that the Fed employed, right, in order to deal with the situation. Granted that we're still in this COVID economic environment, but how would you define success for those two programs?
Yeah, sure, Tom. So I'll give you a narrow answer and then a broader one. I think in narrow terms, success for the PMCCF is to provide a financing bridge so that businesses, as you said, can maintain their operations and payrolls during the shock and then get to the other side. I would say the SMCCF really plays a complementary role by supporting the functioning of secondary markets, which is necessary for businesses to raise financing at a sustainable cost, right? But more broadly, what we want is for the CCFs and really all of the emergency facilities and operations that we've stood up, we want them to preserve the productive capacity of the economy. Okay, so that means avoiding needless bankruptcies. It means avoiding long-term separations from the workforce that might otherwise occur when there's a large-scale credit crunch that hits the economy and amplifies employment losses and financial distress. We know that multiple equilibria are a feature of many crises. So really the goal is to break that negative spiral and the damaging psychology that shocks can create. And instead, we want to catalyze a positive feedback loop between healthy capital markets, a resilient business sector, job growth, and a vigorous economic recovery. That's how I would define success in the big picture.
And we've companies of many different sizes with us today. What would you say is the primary contribution of those two programs over the last several months? Is it the avoidance of economic dislocations, or is it the continuing of some of the markets, or is it a combination of both?
Yeah, it's a good question, and I would say in the big picture, and picking up from my last answer, I would say it's confidence. These backstops have proven very effective in restoring confidence for borrowers and lenders in the private sector to transact with each other again and to finance their operations, investments, payrolls, and ultimately their contribution to economic growth. None of that was a given. You know, as I mentioned in the speech, I really believe that design choices mattered. In the case of the CCFs, you know, they were designed to be large. They're coordinated with Treasury. They're broad-based, and they're flexible. And then I would say the implementation also mattered. You know, we know very well we've been entrusted with a very great responsibility to deploy large sums of public resources. So that's why we've implemented the facilities in the most transparent, inclusive, and accountable manner that we can. That bolsters the credibility of what we're doing, and in turn, that reinforces the impact we're generating and the confidence that we've created.
You know, Daleep, along those lines, and you know, also sort of going back to some of what you said, you know, when we were involved in this in March and April, right? As we were, you know, going through the finalization of the CARES Act and all the work that the Fed was doing, I turned around to our team at one point and said, you know, if you take a look at the work that the Federal Reserve has done in Congress, you know, during those 3 weeks in March, it was the equivalent of about what the Federal Reserve and Treasury did in 2008 and 2009. It was almost a year's work compressed into 3 weeks. And as you said earlier, during that time, everybody's mindset was, okay, we're going to go through a very severe shutdown. It's going to be very short. We just need to make sure we can get over to the other side, which hopefully would be in 60 days or 90 days at worst, right? And it's going to be a V-shaped recovery. It's going to be a hockey stick or whatever metaphor you wanted to use. That's sort of what people were talking about. And instead, you know, we have many economists, including our own economist here at the Chamber, is talking about a K-shaped recovery, right? Where we have some businesses are doing very well. We've got tech companies, we've got software companies that are being very resilient, that are growing, just knocking it out of the park. Then we've got other companies that are just in a free fall, right? If you're in entertainment, you're in hospitality, food service, this is about as worse of a situation that getting through a 60 or 90-day period, we're actually in a much different economic phase than anybody thought we would have been in at this time in early April or late March. So the question is, how has a K-shaped recovery shaped your thinking in the use of these 13.3 facilities?
Yeah. You know, I'll speak about this in the context of the CCFs, but you know, the principles apply broadly to the facilities at large. And it really gets to one of the key design features that I was talking about in the speech. You know, let's take the PMCCF first. The PMCCF is designed to be broadly available to companies in every major sector, excluding banks. And similarly, you know, when I spoke about the SMCCF, what I was emphasizing was that the purchases are also designed to have broad impact. So, you know, our North Star on the SMCCF is to minimize the deviation from a sector-weighted index that's constructed proportionately to the outstanding bonds across eligible issuers. In other words, it's meant to be neutral with respect to sectors, as well as ratings and maturities to the extent possible. So, you know, Tom, you mentioned a few sectors that have been quite directly affected by the pandemic shock. And here I would just make 2 points. One, the PMCCF in particular is designed to help eligible firms that really need it and can't get financing elsewhere. You might think of this as the bottom half of the K. That CF is priced to back relative to. And the second point is, and you've heard this mentioned from many Fed policymakers, you know, debt may not be the most appropriate form of support for all sectors and all companies. And in these cases, more targeted support from other authorities has a role to play.
So is it your view that, look, number one, the primary market corporate credit facility, its job was, and then the secondary market corporate credit facility as well, number one, their primary job was to get the markets back up and running Number two, while you're going to look at industries in a neutral fashion, the reality is probably right now they're helping out those companies or industries rather that are in that bottom portion of the K, right? The ones that are in the K, at the market K, but it's really the practicality is at this point it's helping the bottom portions of the industries there.
Yeah, I mean that's really the notion of pricing these facilities at a backstop rate. So if you have better alternatives through market financing, that's great. To the extent that we've created confidence for that borrowing and lending to occur at rates that are lower than the ones that we're offering, that's a good outcome. But for those that can't access that financing or can't afford it at those rates, then we have a backstop for them. That's the idea. But look, I mean, just to say a bit more, markets are going to do their job of evaluating credit risks across sectors. You know, that assessment is going to influence the borrowing costs of each company, and it will also influence the availability of market financing. But what the CCFs are doing, I think they're reducing the portion of borrowing costs that reflect market dysfunction and illiquidity. Yeah, and they're providing, the PMCCF is providing a broadly available funding backstop for companies that were highly rated before the shock. You know, and we know that if we look back to March, we know that market dysfunction and illiquidity were a big part of the spike in borrowing costs that occurred. And every indication is that we've made a lot of progress on these measures. You know, the improvements are very, if you market debt, the shape of the credit curve, you know, so to the extent that we are promoting the healing of market functioning and we're providing a financing bridge, you know, we're helping all businesses and their employees to get through this shock. And that gives the private sector a chance to do its job, which is to evaluate risk and return and to allocate credit.
Yeah, and a big portion of those well-functioning markets at this point is it also prevents the government from having to spend more money in some of these areas as well. Drilling down a little deeper with the primary market corporate credit facility, you know, with the original term sheet, you know, the PMCCF was given $50 billion that could lever up to $500 billion. As you stated earlier, there actually have not been any direct purchases made through the PMCCF. But as I was mentioned earlier as well, we're also in we're in a more protracted economic downturn than we had originally envisioned. Do you see that there could be a point in time where the PMCCF does engage in some direct purchases while you haven't had to do so previously?
Yeah, so I don't think I'm breaking any news to say, you know, we're living through highly uncertain times, and that uncertainty presents itself in different ways. So I think we could all think of scenarios in which there's a deterioration in market functioning, you know, and the availability or the price or the terms of credit from the private sector begins to worsen again. You know, and in those scenarios, the PMCCF stands ready. You mentioned correctly, it has the capacity to provide up to $500 billion in funding, albeit at a backstop rate. So as we've laid out on our website, the pricing is issuer specific and it's informed by market conditions. And what does that mean? It means the pricing takes into account the issuer's borrowing cost relative to treasuries. And on top of that spread, we add an upfront 100 basis point facility fee against the size of the issuance. And then we add a ratings-based premium for lower rated issuers. So that's what makes it a backstop rate. I'll just add that in a downside risk scenario, since that's really the nature of the question, the spread levels for sole investor transactions with the PMCCF, in other words, where the Fed is the only investor in a company's issuance, those spreads are capped so that the facility's pricing is more attractive when it's needed most. You can find out all these details in the FAQ, but the cap is set around the 95th to the 97th percentile of spreads for each ratings notch over the past 15 years. So that, you know, again, this facility, the PMCCF, it stands ready if there's a deterioration in market functioning We intend to provide that backstop. It will be priced at a backstop rate, however.
So from your view, the PMCCF as a back, this isn't to access the facility because of headline risk.
Sorry, I was on mute. No, I think the dominant reason, the dominant factor for why the facility hasn't been accessed is that markets are functioning extremely well. As I just mentioned, that PMCCF is designed to offer financing at a higher rate than markets. We charge an upfront facility fee. So it's not really surprising that firms have private sector alternatives under current conditions that are more favorable. And that's a good outcome. And I would say that the presence of sizable and flexible backstops no doubt played a very big role in making that happen. There are no specific oversight requirements associated with the PMCCF, but you alluded to it. Those who access the facility, they do need to certify compliance with the eligibility criteria. And those criteria are posted on the boards and the New York Fed's website.
So if we could shift our focus a little bit to the secondary market corporate credit facility, because there's been a lot of probably not as well known as maybe the primary market corporate credit facility or some of the actions regarding commercial paper. But with the initial allocation of equity from Treasury to the SMCCF, that was for $25 billion. And that, there's leverages there with Treasury equity at 10 to 1 when acquiring corporate bonds of issuers who are investment grade, 7 to 1 for corporate bonds of issuers who are rated below investment grade, and between 3 to 1 and 7 to 1, depending on risk. And since I think May 12th, the SMCCF began, as you mentioned earlier, purchasing eligible ETFs and corporate bonds starting on June 16th. You also stated as well about the drop in daily purchases that have happened, which are occurring at about $370 million a day, down to I think about $20 million now. How significant of a role do you think that the SMCCF has had in terms of keeping the corporate bond markets active and liquid?
Yeah, so Tom, I'd actually characterize the situation somewhat differently. I think we haven't had a lot of activity, we had a lot of impact.
Mm-hmm.
So our flows have been very modest and they've been trending lower. You're correct. The CCFs, the SMCCF holds about 13 billion of overall exposure. That's less than 0.2% of the outstanding bonds in the corporate bond market. Our purchase pace is less than 0.1% of average daily volumes. That's about 1/15 of the original pace when we started buying in May. But it's not about the flows. It's really about the signaling that's proven extremely potent, especially relative to the dollars invested. And the signal is that the Fed and Treasury are willing and able to support large employers by restoring market functioning and creating the conditions for businesses to finance themselves through the pandemic. That's the signal. And I think that's why we've seen large inflows back into the capital markets. That's why we've seen spreads compress and bid-ask spreads narrow. I think that's why companies have had a chance to issue $1.5 trillion in bonds to build precautionary buffers and maintain their operations, including payrolls. So I think that's the distinction that's important to understand, is that we can generate a very large impact with a small footprint.
So, Daleep, some companies have been criticized that they've benefited from their debt being purchased by the SMCCF. Matter of fact, I testified before the banking committee on the 13.3 facilities back in June, and I received a line of questioning along those lines. But that criticism really doesn't distinguish between the role, first off, the role of the primary and secondary markets, as well as the fact that when the Fed is purchasing bonds in the secondary market, companies don't have any control at all over what the Fed's decisions are. In your remarks, you explained how the Fed initially executed purchases through ETFs, and that this is evolved into what is now known as the broad market index. Can you further clarify how that approach provides widespread access to the SMCCF?
Sure. Just to clarify, I would say that the BMI, the broad market index purchases, they're not meant to quote unquote provide access. They're Fed directed purchases, as you indicated, that are meant to ensure a smoothly functioning secondary market that allows the primary market to remain healthy. And so when we talk about a broad market index, we're talking about an index that represents the entire set of bonds that meet our eligibility criteria. And then with that index, we purchase small and proportional amounts of the outstanding debt of eligible companies. And we do that at fair market value. Now, importantly, and I think this is getting to your question, what we ensure is that our purchases are conducted in a way that's neutral across eligible sectors and companies. And that's what gives it a broad-based manner. Just going back to something you asked at the outset of your question, you're right that our initial purchases, these were a diverse set of whose investment objectives were to provide broad exposure to the market for US corporate bonds. We did that because they offered an efficient and rapid vehicle to support the secondary market. And then about 1 month after starting the ETF purchases, we announced our framework to use corporate bonds as the SMCCF's primary vehicle for providing support. And that's when the broad market index came into operation. Tom, did I lose you on that one? Just so you know, I can't see or hear you.
Gotta love it when technology works.
Hey, Daleep. Hey,
Yeah.
this is Bill Hulse at the Center for Capital Markets. Work on Tom's team here, and I think I'm going to jump in until we're able to get him back online. We're not sure exactly what happened.
No, this is how it goes in the virtual world. No problem.
Yeah, thanks for your flexibility. Really appreciate your remarks today. I think they've been incredibly enlightening, especially for all of us at the Chamber who've been following these remarks. Not to mention, the work that you all put into this over the last few months. Let me just follow up in the line of thought that Tom was going on. But so maybe there's a couple more questions that we did want to cover today. And so, there's been some, I would say Chairman Powell has made clear his belief that the Fed's monetary policy tools are limited and that Congress needs to provide support to the economy via fiscal policy. The Chamber agrees, and we have vocally called on Congress to provide more support to the economy, such as through an expansion of SBA's PPP to maintain a strong labor force and prevent recession. In a press conference on October 6th, Chairman Powell stated too little support would lead to weak recovery and create unnecessary hardship. So broadly speaking, in designing and implementing the emergency lending facilities under 13.3 of the Federal Reserve Act, what limitations exist? And can you help provide a distinction maybe between what the role is of fiscal policy and monetary policy?
Yeah, sure, Bill. So the Federal Reserve Act is very clear about our emergency powers. You've heard Chair Powell say many times, we have lending authority, not spending authority. So that means we're not authorized to grant money to particular beneficiaries. We can only make secured loans to solvent entities with the expectation of being fully repaid. We also have to ensure that our lending programs are warranted by unusual and exigent circumstances. They have to be established with the approval of the Treasury Secretary. And in the case of these facilities, at least many of the SPV facilities, with the fiscal backing of Congress. And I can assure you, we're following all of those restrictions very carefully. As I mentioned in the speech, we know we've been entrusted to deploy very large sums of public resources. We're accountable to the oversight bodies and the public at large. But within those limits, we're looking for the best way to make a difference in people's lives. And that's why we've been using these emergency powers forcefully and aggressively since March.
Great, thanks for that. And I think just one last question here before we wrap things up. And hopefully Tom can join us before then, but otherwise I'll bring things home. So the corporate credit facilities will cease purchasing eligible corporate bonds, eligible syndicated loans, and eligible ETFs no later than December 31st of this year, unless they're extended. These facilities have been instrumental to maintaining market stability, but they obviously cannot be permanent fixtures of our capital markets. Our economy's long-term growth depends on the efficient allocation of private capital. This may be premature, and I do not want to suggest the Fed step back until there's certainty about market stability. But under what market conditions would it be appropriate to start winding down the PMCCF and SMCCF? In other words, how can market participants start thinking about, the process for the Fed starting to step back from the markets a little bit?
I can assure you I'm not trying to dodge the question, but that really is a judgment for policymakers at the Fed Board of Governors and the Treasury to make based on the 13.3 considerations I just mentioned. Our job, my job at the New York Fed is to be operationally ready to execute whatever policy is chosen. I might just point you, though, to the July 31 announcement of the CCF extension, at least to give you a flavor for the considerations involved. And I would also just observe that the Fed tends to move gradually and predictably, telegraphing its moves, pulling back at a measured pace until it's confident its policy goals have been met.
Great. Well, I want to thank you for participating in our event today. On behalf of myself, Tom Quaadman, who again, I'm sorry about losing him, and the rest of the Chamber of Commerce. Really appreciate you making the time to speak to our members and to others who have joined our event today, and really value our partnership with the Federal Reserve System and the New York Fed. Thank you.
Thank you very much, Bill. I hope Tom is okay. Thanks to everybody out there. Take care.